What if I told you that smart money concepts that everyone is obsessed with is actually making you predictable to the big players? And within my 9 years in the markets, a lot of that time I was actually a smart money trader until I realized the market was changing. So what was once an incredible strategy that had high precision, high risk to reward and simple to understand has now become targeted, heavily manipulated, leading to frustrated traders that continue to fail prop firm challenges time and time again. And if you are not one of those traders that are adapting to the markets, you will simply get left behind and continue to blow account after account. And take it from me, in my 9-year journey that has led me to make millions of dollars in my 20s from the markets and has allowed me to have a public track record of over a year and a half and demonstrating 55% gain, my journey has changed a lot. My strategies have changed, my approach to the markets have changed, and change is normal, especially when you realize the strategy that once served you is no longer serving you. And in this video, I want to expose why smart money concepts no longer works, why you should no longer be utilizing it. And in fact, the beautiful part is, if you understand how they get targeted, you can actually utilize that to your advantage and increase your win rate because you add a confirmation that is smart money traps. So I'm not here to sell you a strategy or give you false dreams. I'm simply here to demonstrate to you why market structure is failing, those order blocks get induced, those fair value gaps get manipulated, and everything that you are doing as a smart money purist is leading to the downfall that you're experiencing, which is why you're watching this video in the first place. And today I'm going to give you a full guide on how to understand smart money traps and how to utilize it to your advantage, take you from a losing, struggling and frustrated trader to a thriving and profitable trader. So with the public signals that you've seen me do and the public track record that I've given, every single one of them I was able to do because I had a risk management operating system. In that risk management operating system, I can completely offload all of the emotions, all of the decision making, all of that is done by AI and my coded risk management system that I'm giving away to you for free. So click the link in the description. This is a free download for you that you can utilize for as long as you want, and I'm completely confident that will revolutionize your trading because it's going to completely resolve your decision making, your emotionality, your risk protocols, and the types of trades you should be taking. And it has some bonus features like a trade log and some stats that you can look along. So for us to profit from smart money traps, we have to first find where they are, understand why they are traps, understand the difference between a valid zone and a trap zone, and then understand how we can trade after that manipulation and utilize it to our advantage. And then later on, we'll take a look at a case study of today's price action, nothing cherry picked, literally something that is repeating time and time again. If you check some of the channel videos that I have, including my most viewed video on this channel, I actually break down many case studies from my public signals that I've documented where I'm utilizing smart money traps for my exact trades and my exact entries. This is not a one-off. This is pretty much a daily occurrence, at times multiple times a day on a single currency pair. And from my track record and public displays, you've seen exactly what kind of results it leads to, what kind of returns it can give for me and also many others in my community, how we've helped so many people get funded, how many people have made thousands of dollars in payouts simply by understanding this concept of smart money traps. So when it comes to this guide, there's a few things that are essential to understand. Number one is going to be our objective. So the way I like to trade and the way I like to optimize it is I'm an intra-session reaction trader, meaning the further we are from the present time, the harder it is to know what price will do with certainty. For example, if I ask you where price is going to be 5 minutes from now, you can be pretty sure that plus or minus 10 pips, there's a 99% chance it will be within that box. And if I ask you, hey, where will the market be at the end of the month? Then you're really going to have to draw a big box and say it could be anywhere within here, 90% chance. Meaning to say, no matter if you have a technical edge, no matter if you have a fundamentals edge, the further you are from the present moment, the harder it is to dictate where price will be with certainty. That's why I like to bring my trading to session trading and still getting the same risk to reward as a swing trader because I'm focused on lower time frame manipulations. And the reason I mention that is because manipulation and liquidity and volatility, all of these things are connected. And therefore, if I can find a volatile moment, a high liquidity point, I can find a high probability reaction. And therefore, I'm able to get a nice strong impulse, catch my high risk reward trade and be in and out in the same few hours. That's the power of this style of trading. And therefore, for us to really maximize this intra-session reaction trading style, we need to focus on post manipulation moves. And therefore, medium and major inducements is a great type of manipulation. And when we pair that volatility with liquidity, we have found a winning strategy. Next thing to notice will be our trend. Trend will always be your friend. But the problem here is, what time frame do I pick the trend on? Because you can have a daily trend and then you can have a 5-minute trend and a 15-minute trend, and all of these trends on different time frames will give you a different read. How do you know which is the real trend? We'll get into that. But once you do understand a trend, then you're going to be trading in the right direction, and therefore you're going to be trading with the volatility and with the liquidity because you are with the trend. And if you can find point of interest based trades, that's always going to be preferred because you have trend and quality zones. And if you learn how to qualify those points of interest, which is something I'm going to do in a moment, then you are really onto the right lines because you're trading volatility, liquidity, qualified points of interest with a trend and quality inducements to give you everything connected together. And you're probably starting to put the dots together. Yes, the smart money trap is a quality inducement we'll be looking out for. And that brings me on to the keyword inducement. If I can find a smart money zone, see when traders are getting invited into those zones and then induced. Invitation, inviting the liquidity, inviting the orders, inviting the stop losses, giving them hope, and then taking them out. Seek and destroy liquidity. That's what we're going to be looking at. And how do we be sure that we're not getting invited and enticed into the same zones? Because we know how to disqualify these smart money zones based on time, based on trend, and disqualification criteria that I'm going to be sharing with you. So it is a full guide, a lot of things we'll be covering. And then the last portion will be your entry, which is always going to be to protect yourself. And it gives you a level of precision based on refinement of your entry. And it feels like a superpower in the market. I truly mean that because it helps your break-even protocol. The sharper your entry, the sharper you can break even and protect yourself. And therefore, whatever you risk, you're actually minimizing that exposure better than anyone else if you master the entry, because you can then master the break-even and therefore you master the protection. And more importantly, if you do have quality entry criteria, it gives you an additional confirmation. That's going to lead to an increased win rate and also a smaller stop loss, therefore improved risk to reward. And when we connect all of this together and we look at the whole smart money traps guide prospectus, we can see we are going to be trading with volatility and liquidity. We're going to be post manipulation in quality types of inducements, and we're going to be point of interest trading with the trend, and we're going to qualify points of interest, and we're going to learn how to utilize inducements there. Then we're going to find how we disqualify losses that we shouldn't be taking, that smart money traders will be, and then we master the entry to be on the right side of the market as a superpower of high risk reward, high win rate, and fast break even. Let's connect all of this together. Step number one is going to be understanding trend. And you can imagine when you have a market, you're going to have multiple trends depending on the time frame. So here I want you to understand your home is going to be M15. Yes, that might sound wrong to some people, but if you're focusing on intra-session and intraday price action, then you better have an intraday based POI. There's no sense in looking at a daily point of interest that might be 50 pips away from today's price action if you're trading today. And more important, if you are taking a monthly, a weekly, a daily point of interest, you've got a massive zone that is really far away from today. What relevance does that have for an intraday trader? So therefore, if you are someone that is intra-session or intraday trading that wants high risk reward and high win rates, you better have confirmed quality points of interest that are not massive, that are refined and qualified. And I'll teach you how to do that, because then you take a 60 pip zone that might exist on the daily and you bring it down to a 10 to 15 pip zone on an intra-session level. That's why I say M15 is home, because we are entering and exiting on an intraday perspective. We better take trend from an intraday time frame, and that's going to be your M15. So taking a look at this price action, you can have multiple portions in an M15 sequence. You can have a bearish portion, which we see in red. You can have the complex pullback portion, which we see in blue, and then the bullish portion. And that is because we take the last lower high that made the most recent lower low. Therefore, anything inside of that range from the dealing high to the dealing low of that range is internal price action. So this internal high, internal higher low, internal higher high, internal higher low, this is internal price action, not a new trend. Therefore, it could be a complex pullback to simply continue this bearish trend that we were seeing. Lower high to lower low, complex pullback, new lower low. The fact that we saw a shift and now we had a break of structure, we had a real higher high compared to the last lower high. Now we have had a market structure shift. We are now bullish, and that's going to open up some areas that leads to this bullish price action. And we also have to continue to look left and say, are we arriving at quality supply zones that we should be concerned about? So first thing you need to do is understand and establish main trend and main push. In this sequence, that main trend and main push is going to be this impulse right here, because this is the most recent higher low that made a higher high. It is relevant from a market structure perspective, and we are not approaching a supply zone that we should be concerned about. And therefore, we know that we have got a bullish market with a bullish main push, and that should be our dealing range of focus. From the swing low to the swing high, we find internal price action and internal entries. Moving on to the next step. Now we need to understand points of interest. So we have points of interest defined by a lower high that made a lower low, breaking new territories that were not previously met. Therefore, we have a bearish push over here, and that leads to a bearish supply level. And the same applies over here. When we break out of this range and we have a new higher high from this low that made a new higher high, entering new territory that was previously a ceiling, that's when we have found a market structure shift. And associated with that, we have a appropriate demand area. These are going to be known as extremes. And then we have to break down the types of POIs and qualify them, which I'll be doing later on. But to qualify them, there's going to be a few types. There's going to be your decisional, there's going to be your extreme, there's going to be your demand to supply and supply to demand points of interest. And then there's going to be weak POIs that we don't really consider. They are non-structurally relevant. But moving on from these types of POIs, you need to also have a qualification process. So in that qualification process, we need to see, did it lead to new territories or BOS? We need to see, did it have a meaningful pullback? Usually I like to use the 50% range. And how I do that in reality is, let's say we have a high to a low, and I see that next lower high, did it cross or reach the 50%? If it reached the 50%, then I can say, yes, it's a POI. If we have a main push and then a small retracement and then continuing lower, and my 50% from the high to the low is here, this one did not reach my 50%, therefore I cannot consider it as a point of interest. So that's what I mean by meaningful pullback. The next thing for a point of interest is I need to understand how long does it spend in my pullback. One thing is basically price going impulse, one candle retracement, and then continuing lower. Or it can be one impulse, a meaningful retracement in 2-3 candles, and then continuing lower. That's not usually giving me too much information. Whereas on the other hand, if I have price doing an impulse and then it spends a lot of time doing the retracement, it's consolidating, it's chopping, and then it goes on to make a lower low. The depth of the retracement from the low to the high is the same. It's just this one happened in a short amount of time. This one happened in a long amount of time. So the time in the pullback, the longer it is, the more information it's giving me, and therefore the better the POI usually can be. And the last thing I need to check is there an inducement inside of my point of interest? When I look at it on a lower time frame, that point of interest that I'm looking at, wherever it may be, whether it's a supply zone, whether it's this demand area, if I can follow this 4-step protocol of did it lead to a new territory? Did it have a meaningful pullback, meaning 50% premium and discount concept? Then the time in the pullback and an inducement inside my POI on a lower time frame, if it has all of these things there, and this inducement, bonus points, if this inducement led to an imbalance, then I've really got my refined IFC and I've got a quality point of interest, and it's all aligning with qualifying your trend, qualifying your points of interest, and refining them to know you are trading in the right area and you're not wasting your time trading smart money patterns and smart money zones in the wrong area. And that's the best way to avoid losses. If you're seeing smart money invitation to enter and it's not in a qualified POI, don't even worry about it. It's most likely a trap. The next portion, step 3, is going to be looking at a smart money trap inside of a point of interest. What I mean by that now is when we break it down step by step, we need to first understand the trend. So when I see price takes out a lower high in the market that made a lower low and now goes on to make a higher high in the market, I've now got a bullish market. So I found a bullish trend. I should be looking for buys. Next, I find a main push. This higher low that made a higher high. We have now found a main push in the market, and that is our trading range. Anywhere within this window, I am interested in trading within that zone. Now, we can qualify this point of interest based on the protocol I mentioned, which is new territory and BOS. Yes, this point of interest led to a new higher high. So step 1 met. Meaningful pullback. Well, from the previous low to this high, we crossed the 50%. We had a meaningful pullback. Time in the pullback. If it consolidated and spent a good amount of time, quality pullback. And then on the lower time frame, M5, M1, did we find an inducement? Let's check that. The reason that last one is important, inducement in the POI, is because on M15, you can have a 15, 20 pip zone as a point of interest. If you want to refine it, you can take it down to 5 pips, 7 pips based on a lower time frame inducement. And therefore, it's going to avoid you taking losses on smart money zones because your point of interest is not too big, and therefore anything in that zone looks like an entry. Well, you reduce the size of your valid zone, and therefore the rest of that is just noise that you don't ignore. A refined POI leads to less losses and more precision, and that's exactly the point of this. And then when we zoom in, this is what I want us to focus on: the smart money sequence, the smart money trap, where it's going to be usually a equal highs, equal lows, a double bottom, double top, triple bottom, triple top, maybe even a bit of a trend line where it's inviting in orders, it's inviting in liquidity. Now, the retail trader is going to enter on this support level or this resistance level or this trend line. This is where retail is. Now, smart money traders go a step ahead and say, we're not going to be like the retail traders. We're going to wait for a manipulation. So what do? They take their zone of consolidation and equal lows. They wait for a sweep. They wait for price to go lower. Why do they want that? It's because all of the stop losses in the zone get taken out. Once those stop losses are taken out, we invite in sellers because people saw a market structure shift. They're waiting for a break, test, continuation. What does that mean? We have sellers stop losses all in this area. When the market does something like this, we take out the stop losses on the low, we take out the stop losses in this zone, and therefore smart money traders are happy and content in the fact that we had a real inducement and manipulation. Sometimes that's the case, but a lot of the times it's a trap, and that's what we need to separate. So we are not in the category of a smart money trap. We understand the difference between a real inducement and a smart money trap. And if you remember from the beginning of the video, this is what I wanted to cover. When we come to our inducements, we need to understand how do we disqualify these areas based on time, trend, and disqualification criteria. So let me reveal some of them to you now, but not all of them. A disqualification criteria is going to be time. If you are trading at the wrong time of day, in the wrong moments, you are more likely finding yourself in a smart money trap zone. Number two, if you are trading without the trend, if you are trading counter trend zones, you're selling at a higher high, you're buying at a lower low, these are non-intuitive places to be looking for a trade, and therefore more likely to be a smart money trap. And the last one is going to be weak zones. For example, you're trading a smart money pattern at Asia high liquidity, an area where you know there's more likely to be an inducement than it's going to respect. So therefore a zone you should probably avoid. So Frankfurt Open, a time to avoid. New York Open, a time to avoid because that's usually a trap. Higher highs and lower lows, don't be buying and selling there. And don't be trading out of key windows. Why are you trading during the Asia range on a Euro USD? Maybe you should wait for the London Open or the New York window. Another disqualification criteria can be the efficiency of the pullback, something I've explained on the channel a few times, and it's essentially going to be price coming to a local supply. Price is doing the smart money sweep of these equal lows and then hitting a supply level. And for all we know, price will go on to make a lower low. So we don't want to be buying in this area based on the fact that it's come into supply and therefore we have doubts. Another one is going to be time. Another one is going to be if this is Asia range. There's a few disqualification criteria to not take a trade in a smart money trap zone. And what we're probably going to see is as price arrives into this smart money zone, the market might even give them a bit of hope, but eventually it will take them out. It will take out the smart money zone, this reaction that invited in more traders, the zone that was an order block for smart money traders. We get a quick manipulation, it dips lower, takes their stop losses, and then shoots in that direction anyway. So the key points we need to look at is zone of liquidity or build up, a sweep from a smart money perspective plus an invalidation criteria, and then a real inducement based on the time of day, what it induced, and lower time frame confirmation to really take the correct trade. And then you have volatility and liquidity on your side to be trading in the right side of the market with the trend, with the volatility of the session, with the liquidity of the manipulation of the smart money zone. That's how we connect it together. And based on this example, we can see it's a POI, points of interest based smart money trap trade. Assuming we have lower time frame confirmations and time window, we are trading in a sniper way. And for the last one, step 4, let's reveal it. This is going to be our non-POI based trade. Very, very similar thing where we have our main push established from higher low to higher high. We have now found a trading range. We find the smart money build up. We find a smart money manipulation. We find a smart money trap reason because we have an invalidation like coming into supply. Then we get the real inducement that is taking out the POI. Therefore, we have found a structural inducement, therefore a major inducement on top of our smart money trap. So when you stack these things together, you might have Asia low liquidity taken, smart money trap liquidity taken, and structural liquidity taken. And if this is in a London Open, you've got liquidity plus liquidity plus liquidity plus time. And if you have a entry confirmation, you have now found a wonderful opportunity to be taking because you are now with the trend and with the flow of liquidity, momentum, and volatility. Everything connecting for a wonderful intra-session dream. As an intra-session trader, this will be high risk reward, high win rate, and fast movements towards your take profit level. Everything you could ask for. And before I get into this full guide breaking down everything you need to know about smart money traps, how to identify them, how to utilize it to your advantage, and then showing you some case studies to see it in action, I want to tell you about a free gift that I have for you. And this is literally a free gift to completely solve a regular problem that is risk management. When I speak to a lot of the prop firm founders, every single one of them tells me the same thing, that the number one reason people blow accounts and keep failing challenge after challenge is not because of a strategy. It's not because they hit that minus 10% drawdown. It's because they blow the account in a single day. They've even said people that have gone on to get funded and traded perfectly, the moment they are funded, they blow the account in a single day. And the reason for that is people don't have a system for risk management, and the emotions of the stage of a funded account gets the better of them, and they don't have anywhere to fall back on for their emotions or their systems for their risk management. Okay, so let's do a quick read of price action, and we can clearly see lower high, lower low, lower high, lower low. We are in a bearish market, and within that bearish market you have your internal structure, because we have a new lower low compared to the one on the left. Then we have a lower high that had a build up and an inducement that led to a lower low, that led to a lower high, and then this is the lower low. So we have the bearish main push. the associated supply level, and then when we have the internal bullish price action that I was showing you. That internal bullish price action can be a complex pullback, but when it fails to continue that bearish trend, fails to make a lower low, makes a higher low that goes on to make a higher high, we have now had a market structure shift bullish, exactly like the diagram, and now we should be with the trend, which is looking for buys. And associated with that new trend, we have points of interest, areas of demand, higher lows that made higher highs. We have one over here, we have one over here, and then we have this one over here. So all of these, we need to qualify them in the correct way, which is going to be number one, did this area lead to new territory in a BOS? Yes, it did. Did this one lead to new territory? Yes, it did. Did this one? Yes, it did. First criteria met. Second criteria, was it a meaningful pullback? Well, from this previous higher low to higher high, this crossed the 50%. So it's meaningful. From here to here, we have a more than 50% retracement. And on a lower time frame, we'll qualify this one. The next one was inducements. Did this one have an inducement? Yes. Did this one have an inducement? Yes. So we have quality zones based on the pullback, and we have time in the pullback, which is not just one candle. And therefore, when we bring everything together, we have found trend-related points of interest that we have qualified. Now, because price is all the way in this zone, I don't need to worry about price down here. That's not going to be relevant for today's trade, today's price action. So I need to just focus on this area, and that's why I don't spend too much time on higher time frame. The 4 hour is also not usually common for me. I'll usually jump down to M15 and see what action is there. Now, when I am on M15, the home time frame we should be on, we need to first identify with the pro trend that was bullish, the main push. From higher low to higher high. That establishes for us the swing low of our external range and the swing high of our external range. Anything inside of here is internal price action, and we know because we are with a bullish trend, at some point we need to have bullish price action to go and make a new higher high and break the previous high. That could be from this demand area down here, based on the fact that we have this order flow liquidity, and then we have this inducement right here. So we have an inducement based demand area that led to a higher high. Price could be bullish from here. But that's not the only area, because we also have another zone where price had a buildup of liquidity, and then we have a potential inducement, and that inducement led to a higher high. So that's also relevant. So there's two areas I need to be looking at, somewhere down here to make a new higher high, or somewhere in this area going on to make a higher high. Both are valid options. But now when I take a look further and I want to mark out my higher zone, I start to realize this demand area from higher low to a higher high, price already tapped into it a few times, once, twice, 3 times, 4 times. It was consuming more and more each time. But we can see as we came into demand and consumed it more, we failed to break structure. We tapped in once, didn't clear the high. We tapped in another time, didn't clear the previous high. We tapped in another time, didn't clear the previous high. So we can see that sellers are maintaining control and the buyers are trying and failing. There's not enough liquidity from the buyers, and all of this bearish trendline liquidity is forming. So we know that at some point this will get targeted. So I'm going to mark this out as a huge liquidity pool, because I know at some point this will get attacked. And I know once we have a meaningful inducement around this demand area or down here, this will all be targeted as liquidity. Now, when I start to look at it even further, I start to realize maybe this whole demand area was a smart money trap, because we had the build up, we had the run of liquidity, and then price failed because we failed to break structure. That was one of our main disqualification criteria, is that if price comes into a demand area that is a smart money zone and then hits supply, we cannot look for buys because there's no intent. It's like an elastic band. If you pull that elastic band as far as you can and you let go and it just falls, you will know that there was not enough intent in there. So in the same in the market, if you pull that elastic band back, price is coming into a liquidity zone that was demand. Price comes in and fails to make a higher high. Price comes in again, fails to make a higher high. It's like that elastic band failing and failing. When you see price break more liquidity, you're pulling it back really far now, because not only are you inducing areas on the left, these previous lows, you're also inducing the whole demand area, the whole smart money zone. Smart money traders are taken out. You've pulled that elastic band really far back. You've taken as much liquidity as you want. And then as soon as you see bullish shifts, that's when you know that the buyers have taken control. Cause and effect. Now, when I add in my custom tool, my session markers, something I made for myself, that helps me understand where the Asia ranges are in the key time windows. We can see that there's more liquidity pools. And if I jump to M5, I'm going to start to mark all of this together. So down here, we know this was an inducement of a smart money zone, because we took out a demand area and it took out a smart money zone. So it's a smart money trap plus structural inducements. And what do we see happen after that? We see the last lower high that made a lower low, leading to a bullish break of structure. This area that could have been a supply, because it's a lower high that made this lower low, price comes back into it and does not go on to make a lower low. So this is showing me this inducement is holding price. It made a higher low. So now we have inducement plus BOS plus higher low. And then we have this whole region where price is consolidating, kind of hitting into this supply zone, tapping once, tapping twice, but not really showing intent, but also not showing bullish intent either. It's holding. So I need to understand what's really going on here, and that's when the daily cycle comes in and we layer in more intent. And this is where I focus on the fact that we have a build-up over here, but at the same time we have a build-up on the high. We have all of this liquidity high, we have all of this liquidity low. So when we have this liquidity high and this liquidity low, we could say this could be a manipulation, this could be an inducement. Why? Because this inducement led to a bullish push. But at the same time, we could say, oh, but this could just be a bearish inducement and we're grabbing this liquidity and we're about to make a lower low. So we know that we have arrived to an inflection point because this zone says look for buys and this zone says look for sells, this inducement. So if you are looking to buy in this territory, it's a 50-50. Could be a buy, could be a sell. This inflection zone is to be avoided. And that's another reason you don't trade outside of your key window. Until this dotted line from my custom tool, until London Open, I'm not interested in a trade because Frankfurt can usually be misleading. When I see price is now holding that level, we see this demand area that I mentioned. We see prices chopping around this area and then eventually we get a bullish break of structure. We get a shift in the direction post-inducement. So now we can say this buildup of liquidity and this inducement that led to a bullish breakout failed to make a lower low and took out this zone that could have been an inducement based on this liquidity. That's all failed, and this is just showing me higher high, higher low, higher high based on the fact of this inducement. And where are we? A few minutes out from London Open. Where is my relevance refined IFC? Right here. And therefore that for me is a perfect trade as a continuation model. You guys asked for a continuation model and this is exactly it. So if you put your stop loss at the low just to be safe and you target where? You target Asia high liquidity, you target this trend line liquidity, and you know you are with the trend on a higher time frame. So eventually you can go on to make a higher high. There's a lot of potential places you could take profit and a great risk to reward potential. And this is the domino effect I speak about. Once that first domino goes, you look for the next domino and the next domino and the next domino. What was that first domino? It was a smart money buildup, a smart money run of liquidity, and then that whole demand area failing with a structural inducement, proves inducements are real. That was the first domino. And then when that first domino happened, and that mitigation happened as the second domino, and then this manipulation as the third domino, we can see that the dominoes are falling to show buyers are in control and sellers are losing control. Because not only after the main inducement do we have internal bullish price action, bullish signs, we also have bearish zones failing. This area that could have been a build-up and a run of liquidity goes on to fail. So this for me is a very nice continuation trade. Worst case scenario, it goes to my Asia high, and for me it just gives me my 1 to 3 risk reward trade. Best case scenario, goes on to make the new M15 push, and my break-even protocol will be right here. Price taps in and shoots right away to your target one. We can already see Asia high, our first target, is our first profit target. We always take a partial at 1 to 3, always. So we can already see from our entry to our first partial, it's happened in the space of 13 minutes. A fast reaction going from the domino effect of the minor inducement, bang on London Open on the minute, leading to our liquidity target that is Asia high. 13 minutes, 1 to 3 risk reward, take your partial. It can't be easier than that. High risk reward, high win rate, quick feedback, and locking in a partial very, very easily. This is the power of intra-session trading in this way. And then we leave the rest of the volume to go to our next target, and we're break even at this point. And then I'm just going to leave the rest of the day to play for you. And this is when you start to understand that this type of trading is wonderful, is very powerful, and we just keep following the inducements. Another build up, another inducement, another mitigation, liquidity cycle showing me the next domino, buyers are in control, and we continue up and up and up, and prices maintain profits. What happens right here? Some build up, an inducement, a bullish push out. What does that tell me? The next domino, buyers are in control. Price comes into the key window. Now in this key window, what a smart money trader is going to be doing? They're going to be saying, oh, we have a build up of liquidity over here. Beautiful. We have a run of liquidity and supply zone. Why is it a supply zone? Because we had a break of structure here and a lower low. So they're going to be looking to sell from here. Let's look back at a second. Let's take a look where we are. If we are at a higher high, this is a higher high in a bullish market. This is not a supply zone. This is something I mentioned at the beginning. Smart money traps happen in certain predictable areas like Asia high, like higher highs. If we are in a higher high zone, which is a smart money trap zone, and then we get a smart money trap pattern, and we can see all day long the buyers are in control. Domino of the buyers in control. The next domino of buyers in control. The next domino buyers in control. The next domino of inducement buyers in control. Why would we sell here? This is a smart money trap. It tells me keep holding the buys because it's going to make a new higher high from here. And like clockwork, continues higher and higher and higher. And when we look back in a single day, within the space of 13 minutes, we got a 1 to 3 risk reward. And by the end of the day, we could be up 1 to 15 in a single day. This is the power of high risk reward, high win rate, inducement based, smart money trap based trading. And as long as you follow the restrictions and rules that I've shared with you, it follows that philosophy that a restricted trader is a profitable trader.